Morning, everyone. I'm back here giving you a strategy of the day update here for September 20th, 2021. Remember, trading futures involves risk and is not suitable for all investors, and everything I talk about here today is just my own opinion and not a direct trade recommendation. Today's a good example of a lot of outside forces weighing or having an effect on our agricultural markets. The biggest of which, hitting international tape here, is the fallout of two major Chinese development firms where we're effectively seeing a lot of the fears come to fruition for a lot of the policy-driven economic expansion in China. The very quick elevator discussion or explanation of what's going on is that in China, most of tax dollars that are collected from municipalities, in fact, all tax dollars collected by any city or municipality go back to Beijing to then be redistributed among cities, however the party and the Beijing sees fit. Therefore, the only other additional way, and they don't have control of their own individual taxes as a city or municipality, so the way that they can raise additional funding for other projects or expansion that they need or for whatever reason is by rezoning rural land around cityscapes and creating new urban land that then can be sold off to developers. Those developing companies are buying this land on leverage. There's been unprecedented expansion of cities in China over the last several years, last decade or so, and it seems to be that process of policy expansion has now caught up with the real financial institutions that are behind a lot of it and defaulting on loans because of buildings that are not bringing in revenue but continually spending money on new buildings is an unsustainable means of expansion. It seems to be now coming to light in the financial markets that the bubble has popped. We'll see how that plays out, over the next couple of weeks. This is probably not something that goes away. And as they say, when China gets a cold and sneezes, the whole world, or when China sneezes, the whole world gets a cold. So we're seeing some risk on in the U.S. markets. A big outside day here for the S&P 500, an outside day for the month as well. Outside month now, with an all-time high being formed at the start of this month and now solidly below 4,400. We see some pretty big risk off. That is translating to a market here, the dollar index in our currency markets, which are going to have the biggest effect on our grains. Now, the interesting thing here is that in the U.S., we have kind of some firewalls between our agricultural sectors and government policy for the most part. In other words, Fed policy doesn't necessarily directly affect our soybean market. However, in China, all of those policies are very much party line and centrally located within Beijing. So there's much more of an economic fallout when something fails. When Lehman Brothers failed here in the U.S. and Bear Stearns fails, it doesn't expand into our agricultural sectors directly. There might be some other things that have happened, but when these development companies fail in China, they definitely affect the bond quality of other municipal bonds and the purchasing power of the actual government and the quality of that is coming out of Beijing. So, not to mention, Beijing also being responsible for a lot of ag purchasing. This can have a fallout that is an unforeseen issue here that we're not discussing yet, and might be a big reason why China over the last couple of years was so adamant on stockpiling things like grain and energy products, because this inevitable, debt bubble popping might have been on their radar. That's all speculative. I can't confirm that that's the reason we saw this, but it sure is better than some of the other conspiracies out there of that China's readying themselves for war and other things going on in the world. It seems to me that there is more of a turtling up or a stockpiling and hoarding going on of real commodities, getting ready for some kind of financial fallout, which inevitably debt cycles need to pop. We need to have a reset, and these things happen. So all that aside, though, what we do not know is how this issue with Evergrande and I forget the name of the second company that has fallen apart now. We don't know how the extent of those fallouts will have dramatic effects on China's ability to accumulate and purchase grain. What we do know is that any kind of shock to the Chinese financial sector represents a shock to their ability to do business abroad, because any of the notes that are utilized and leverage that are utilized to purchase physical grain and the banking that's done through those factors, if their creditworthiness is at challenge by the international community, they might not have such an easy way of buying grain in the near term. But hey, all that aside, what we do know is that it has caused somewhat of a risk-off situation here The S&P 500 and the Dow down pretty big today. The U.S. dollar, the chart I have up here, the Dixie, that has rallied here pretty significantly since last Friday and last week. We talked about a head and shoulders pattern that could be forming. That right shoulder looks like it has to be complete at this point. If we start to press higher, and I would say go above today's high, this whole idea of a head and shoulders pattern happening for the dollar and then looking for a little bit of a lower drop in the near term below this neckline down here around 92 is probably off for the time being. And we're going to be seeing a potential continued rally here for the dollar that could take us up towards the 95 to 96 area, which there's nothing wrong with that. Technically speaking, we have the 50-day moving average here at 92.60 has moved above the 91.70 100-day moving average. So we have a pretty good technical reason for a dollar rally to be sustained. But, last week we started to point out this whole head and shoulders pattern forming for the dollar, and a lower dollar would be a lot more conducive to a strong export market here in the U.S. Chinese purchasing and wheat and soy products, for example, and even corn that we would be looking for in the near term. Now, with the drop in prices on the board, with a rallying dollar, we're starting to see some of the adverse effects of purchasing power from our export partners taking hold in the grain market. And that's something to be aware of and look for here into the near term. So again, this head and shoulders pattern in the US dollar index that's been forming over the last couple of weeks, if we start to press above today's high, certainly get above that head at 93.70, that type of idea I think would be off the table. And we'd be probably in a period that's going to last a couple of weeks, maybe into the fourth quarter here, that would take us a little higher in the US dollar in the near term, weigh on our export markets a little bit, and we would ultimately need to find where that demand for our grain prices are on the chart. So let's take a look here now at I don't want to switch just yet, actually. Let's go over to the daily chart of November beans. We'll begin there. So the full 50% retracement from our lows at 826 to the highs at 1480. Just a reminder, everybody, that comes in around the 1150 area. We had this area of congestion on the charts between January and February of this year, around the $12 mark, where we've had a fight over the mark to break above, right? We hold it as support here into March, and we rallied all the way up to 1480 to make highs for the year. There is a bit of a triangle or that sideways price action we've been talking about. Trendline support here that began with the June 1240 low through this low here at 1275 in August. We started to break below that level over the last couple of weeks. We've been fighting with it to hold it as resistance, and we have rolled over here a little bit off of it here today. After failing to break back above that trend line support, as well as this 18-day moving average here at 1291, now holding as resistance on this chart. We also had that bearish crossover, the 55-day moving average at 1330 today, broke below that 1350 100-day moving average there back on August 24th, and we've come down to now test the 200-day moving average, which comes in at 1268 yet again here. So we've kind of to roll over in the markets, and maybe we might be now confirming for a move down towards at least down to a test here at this point of this 1240 area, that June low, and we could be seeing the market move a little bit lower in the near term down towards that $12 handle and maybe even a little bit lower. We'll take a look here at that 4-hour chart.
In the upper right hand corner where it says done, press done or whatever it is.
Let me switch to a 4-hour chart because I want to show you where some price measurements are that we've been looking at. Here we go. So the 1480 highs down to the 1240 lows here. Take that $1.40 drop, extend it from the 1423 highs or this 1380 high. You've got a 1180 or 1140 equal legs zone that we have, and right between that is the full 50% level at 1150. I'm anticipating the market probably getting down into that area at this point. Again, we need to see a solid break below the lows of today. We made a new low for the month of September here, but sustaining that break lower is what's going to be key in the near term. because otherwise we really are just in a much larger range in soybeans. But it's worth talking about all the failed attempts to rally this market, holding below trendline resistance, and now holding kind of 50% shorts off of the most recent highs. Speaking of those, from the 1340 highs down through the lows here of September, we're holding that 61.8 line and that $13 level. The next level above us would be around the 1320 now mark. That's that downward sloping trend line against the highs and would be the full 50% short from the highs at 1380 down to lows. So the congestion zone between $13 and 1320 still holding as resistance, breaking down to lows here. We can't really deny at this point this market is struggling. It's had every attempt to try to continue and sustain a rally, but here we are yet again down 20 cents on another day. 15-minute chart. Trendline resistance against the highs here held this morning on the rally up into 1275. That was basically the next in the series here on a market that's stair-stepping and technically trading lower in a series. So the first here was around 13 bucks. That high at 1308 highs down to the 1290 lows. $13 level held as resistance. Next in the series there held from the 1298 highs here down to that new low. 50% here held, went down into its target area. The next level was actually the extent, it was the same day. We had a 50% short again for the day. This was last here on 9/16 on Friday. From that 1298 high down to the lows, we came up into the 50% area around 1288 into the end of the day. We had downside targets down around the 1270 level into today. Market sold off in the Sunday session down into those levels. Now, from Friday's afternoon high down to this morning's low, we had that spike high here at the open, which took us, again, right up into a 50% level. So 1288 highs down to the lows overnight and really into the morning session at 1265. We popped up into 1277, 50% level. Now we're trading what looks like lower down into the 1260s. That morning high to the low here, after we probably have a 1270 resistance here in the near term if we have any kind of move higher. But generally speaking, this market looks like it's already started a little trend lower. Let's see what happens then around 1260, and if things accelerate as we looked at on the bigger charts, there definitely could be some capitulation lower down towards the lower 12 handle, and just below there, 1180 to 1140. I think that's where we'll find some real demand again for these charts. So we'll see. Still very much in a range until it's not above 12 bucks and above the 1240 area. But it's, the market just continues to fail to be able to break out. And again, at this point, hopefully we've got good sales done from a marketing perspective. Hopefully we own some puts, if nothing else, or like we looked at in last week's Strategy of the Week webinar, even some call spreads that, hey, on the way down, those short calls give you the ability to buy back some premium to then use that premium gain on those short calls to roll down the long calls of a spread if we do get this break lower to make them a little bit more attainable. But with all that being said, I think that we're currently into a downward trend here over the last 3 days for soybeans. That is probably going to take us through that June low now that we're starting to try to break below that 200-day moving average. So let's see what happens. All right, next on the charts, let's look at December corn. December corn at the end of, when it's all is said and done, we have been fighting to break back above this 535 to 540 congestion zone. The market came back up to test its broken trendline support here as resistance. We're back below the 18-day moving average here, which comes in at 528 here today. The 55-day moving average at 543, and the 100-day moving average here at 554. There's a trendline resistance against the highs that would probably keep us below 570 to 560 at this time if we go back up. At least, on first test or something, we would be looking for the market to break above that level to be able to obtain, $6 and $6.50 and $7 corn, which I do believe at some point will happen. It just feels like this market wants to head a little lower in the near term to follow soybeans and certainly the U.S. dollar higher. means a little bit lower. The 200-day moving average, though, came in as great support here last week at the 508. Well, it came in as support around 504. It's come up to 508. It feels like the market's trying to come down to test that area. On the short time frame, though, corn is holding a key supportive area that I talked about last week, and we'll look at what that might mean here in a second. So there could be still another fight over the trend. From contract lows of 355 to the highs after, that full 50% level right at 497.5 traded on the right on the nose and got us a bounce from last week. But I am very concerned about that old congestion zone, similar to beans at the 1150 area. It's the 450 area here for December corn. We fought to break above it here to start the year. We held it as support. I wouldn't be surprised to see us retest that level. And of course, we have that big old open gap down around 477 if corn wants to head a little lower. Let's break down the 4-hour chart real quick, and we'll dive a little bit deeper here for December corn as well. But a great bounce today off of a key supportive area, and I'll get to that in a minute. So that open gap down around 477, the longer that gap remains open without being tested or filled, the more bullish this chart looks. We definitely are continuing to hold resistance trend lines against the highs, and you can make a good case this market looks like it's rolling over a bit. The next in the series, 50% short, drawn from 558 highs down to the 497 lows, though. That area of resistance, I would have expected to see us kind of stay below 527 to 530. We came up and we actually hit that 61.8 line and went through it a little bit. So traditionally speaking, that means I would remove this fib from a chart and immediately draw up the 50% fib from lows of 497.5 to the highs of the month at 537.5. Talked about this level last week that we really would want to see corn stay above the 515 to 512 to 517 area. Sure enough, we came down, have held that area as a support, and now we're back up to testing trendline resistance against the highs. We fail from right here at 522, however, and roll over on the day for corn. And certainly if we roll back over below yesterday's low at 521, that level still remains in question. And if we get another test of the 515 area and 510 area, we could certainly press down to another test of $5 because this market does still continue to look like some broken trendline support being tested as resistance. Wasn't a great fib hold, but fibs aren't the end-all be-all of price measurement and price structure, technically speaking. And as we can see from our moving averages from our daily chart just a minute ago, we're still below many of those key levels for December corn. So if we do continue this rally, we break above 525, we break above highs of the day and the highs of yesterday, I would say that then I'm a little bit more bullish December corn, at least for a move back up to the 550 area and to the median price that this chart has had over the last several months, and probably more than likely a test towards the 570 to 580 trend lines. Could we get as high as $6 and test the highs from the month of August and that downward sloping trend line we've held since our contract high? Absolutely. Corn would just be in a big old range caught between $5 and $6.30 or 40 at that time. So we would expect corn to kind of trade in some kind of trend higher. But if we do fail and break down here today, which let's go down to a 15-minute chart to kind of show you how this area around 520 has really put up some good resistance at this point. If we fail to break above yesterday's low, this downward sloping trend line against the highs, and honestly, you could make a case here in the very near term, though, that corn had maybe a little bit of a series of measure moves to the downside that it's still fighting to hold here. That if it does continue lower from right here, there's pretty good technical justification as to why it's happening on the near term. However, the bounce and the reaction we've had off the lows of the day, it's not translating as much here into the soybeans as it is for corn. But here we go. As we're talking, we're continuing to catch that bid and put some pressure on that downward sloping trend line. A break of which probably going to retest highs of the day. I would say that today's open left us with a little bit of a gap from yesterday's close, which, hey, if corn wants to go up and test the full 50% from its highs to its lows here, would take us right up into that gap fill around 527. So look out for that area as resistance too, but at this point, I would rather see corn stay below the highs it's trying to form right now and roll over if it's heading lower. And we'll see what happens in that regard here soon. So let's take a look now at Chicago wheat, which is slipping below the $7 figure. Talked about maybe a secondary head and shoulders pattern trying to form on this chart. There's definitely a few trend lines that you could draw up that we've come into contact with against the highs. But most importantly, I have one drawn here from after this first drop. There's a number of highs that we held in that consolidation while we were trying to break back below 720 that is coming in. And honestly, it's really, I think, just the 18-day moving average at the end of the day that's forming that area, which we are now below. Today's break lower, we broke back below the 55-day moving average as well at 708.5, the 100-day moving average at 702, and the 200-day moving average for December wheat, Chicago wheat, down at 671, remains unchallenged and untested. And it kind of feels like the market might want to go down there to test that. Certainly, with a positive and rallying U.S. dollar, our wheat markets prices above $7 seem to be a little unsustainable at this time, because that destruction of demand we would have at these prices is just going to weigh on the markets, not to mention the technical trade that we see kind of playing out on the chart. December wheat, as I mentioned, let's go to the 4-hour chart now. A little bit of a head and shoulders pattern we watched play out already, which broke its neckline and headed down to its swing low target. That the original one was a high that formed around the 740 area. Big head here at 784 for the neck, shoulder or head. Right shoulder came up to test that 740. That neckline at 720 broke, even tested as resistance yet again, and we broke down to a 677 low, which really hit the lows, the prior swing low there from July. Now we've got a little bit of a bigger pattern forming out with a left shoulder here, again, from the 725 area forming from July. The head still at 786, and that right shoulder might have formed here in the 716. It didn't get as high as maybe 720, but we're still certainly holding downward sloping trend lines. We did not even get to a test of the to the September highs there for wheat, and we've rolled back over. Now, just like corn, however, September wheat has a full 50% retracement from its 677 low to its 716 high, which we're holding here today as support around 696. We'd really need to see the market reestablish itself above $7 here. I'd need to see it get back to 710. But if it does, there's perfectly ample room on this chart for it to make its way back to 720 to 730, really form that right shoulder in that larger pattern I was talking about. That would take us back to a full 50% level from the 786 highs, which I'm highlighting now on the chart, looks blue, which comes in around 731 down to its low. And if we rolled over from there, then we might have the downside target towards 620, which could be in the works here now. But as you can see, that trend higher we had from last week kind of broke. We've now trend line support here. Removing that from the chart, we've now got, going down to a 15-minute chart, get a little bit of trend line resistance against the highs here today. That if we continue to hold basically below $7, we could see some more downward pressure on this chart. Below 690, I think, would accelerate that selling pressure back down to the prior lows, and probably some fear selling would take over. Look for this market to do the same thing and trade pretty closely to the dollar too. So I would be expecting some more dollar strength if wheat's going to continue to break down as well. But I think also at a $6 or $7 handle, wheat has its own destruction of demand here occurring without the currency falling apart itself. So, and I guess real quickly here today, cattle. Look at hogs very quickly here, getting a big reaction off of the equal leg still. So that is a swing from 889.5 down to 73. Extend that from the 86 highs here. You had equal legs around the 70-80 figure. It's also the 61.8 line of the contract low to high. So you had a big fib inflection zone between 74 and 71, which today's price action seems like an outside day. It's inside its last range, but a double test of that low and a good sweeping reversal. We continue higher here, 50% off of contract highs at 89.50 down to 71.50, coming around the 80 area. Would be a test of broken support here, broken trendline support as resistance, and I think could be again another test of that broken July and August low here at the 77 handle for the December hogs for the market. So again, though, we need to see the market break above the 75.50 area, I think, to have a little bit more faith in the upside, but a good technical reversal might be underway there. And last but not least, live cattle here in the December contract. We broke down to fill that gap here at the 127 figure. Got a nice snapback reversal on the day to be just fighting barely to stay positive for the day. We have a trend line against the highs we need to be aware of now, of kind of a new one. We start to get above this 128 figure, certainly above the highs of today. And I'm looking for the highs of yesterday at 128.40 or last Friday. A break above that, I think we could be making a longer time frame bottom here for live cattle. And I'd really like to see the market get up to test into the 138.22 lows to the 125 lows. I want to see us get back up to test that 132 area, which if you take a step back on the 4-hour chart, would be a retest of our broken trend lines that took us up to these levels. Now is broken support, now is resistance, and the full 50% retracement off the highs. Now that we're kind of breaking above this trend line resistance that defined the trend to the downside, now have tried to establish ourselves above it. So long as we remain above this 126 low here for today, there's a pretty good reversal going on in the cattle intraday wise. So, all right, well, with all that being said, I hope everybody enjoyed today's Strategy of the Day update. Kind of went into a lot here and a lot of ground covered. And remember, you can always get in touch with us over here at Zaner to try to put together some of these trade plans for you. My number is 312-277-0110. There's no better time than right now to have a discussion about your marketing plan or your trading philosophy, and it's something that we would be love to help you handle. Find me on Twitter or Facebook, or shoot me an email at dhussey@zaner.com. Have a great day, everybody. Sign up in the links below, of course, to receive our free Zaner Daily newsletter, to get our entire team's commentary on current market conditions, or join me every Thursday at 2 p.m. Central for my Strategy of the Week webinar, where I put some option strategies and other trading ideas in front of you that I find are some of the better opportunities for whatever the current market conditions might be. And that sign-up link is, of course, in the comment section, as well as the video details below. Have a great day, everybody, and we'll be back with you as price action develops.